Hi, I'm Scott Robinson, Director of the REIT Center at NYU's SPS Schack Institute of Real Estate. I am fortunate to be co-hosting the 7-part REIT leadership series with my friend and industry colleague, Robin Panovka. Robin co-chairs Wachtell Lipton's real estate and REIT M&A practice with Adam MREIC, both of whom have long supported the Schack Institute of Real Estate, notably as conference co-chairs of our annual REIT symposium held every spring in New York City. For more than 50 years, the Schack Institute has been at the forefront of real estate education, guiding over 700 matriculated students annually through numerous non-credit and degree programs, including a Bachelor of Science in Real Estate, MS Real Estate, MS Development, and MS Construction Management. This REIT Leadership Series was designed to bring our students and numerous stakeholders into a direct conversation with some of the folks shaping our industry today, including Jay Brown of Crown Castle International, Tom Bartlett of American Tower, Aaron Block of Metaprop, Eric Bolton, Mid-America Apartment Communities, Stuart Tanz, Retail Opportunity Investments, Tammy Jones, Basis Investment Group, and Mike Landy, former CEO of Monmouth Real Estate Investment Corp. Importantly, I want to thank the many NYU Schack students who participated in this series and leaned in to prepare accompanying research around the conversations, including Ivan Chen, Emma Denhausen-Braun, Sam Penny, Jacob Bernstein, Ross Hewitt, and Cameron Spiller. Thank you. The topics of conversation among the CEOs in this leadership series are generally focused on each individual company's strategy, but I hope you'll see that they can also be categorized into major themes such as digital infrastructure, leadership, M&A, and specific industry trends. I hope you find these conversations and the related research memos informative, and I look forward to exploring these topics with you further on social media in the coming months.
We are thrilled to welcome Mike Landy as a distinguished guest speaker in our REIT Leadership Series. Welcome, Mike. Mike is an alum of the NYU Real Estate Program who rose to become the CEO of the Monmouth REIT, one of the most successful REITs over the last few decades, which recently sold itself in a record-breaking, very, very interesting transaction that Scott and I were also involved in. So lots to talk about there. Mike is also on the board of UMH, a manufactured housing REIT, and he and his family are among the pioneers who helped create and build the entire REIT vehicle and REIT market. So should be a fascinating chat today. Mike, if we could start talking about the strategy you used to build Monmouth, the big picture around that. I mean, you somehow had the foresight long before COVID, long before the acceleration of e-commerce to move into the industrial REIT space. And it obviously paid off in a big way. And you ended up in a fantastic transaction selling the company, which created amazing returns for the shareholders. But go back to kind of the beginning. What was the strategy to build this company? How did you know industrial was going to be such a sweet spot?
Well, you know, it's a long process of whittling things down and refining things and narrowing our business model. Monmouth was founded in 1968 by my father. I was 6 years old in 1968, and REITs were only 8 years old. So REITs were conceived in 1960, and back then nobody knew what a REIT was. And he started the company with under $2 million in capital, and we were a hybrid diversified REIT, meaning we invested in all property types and invested across the capital stack. And in so doing, learned what works. And then you fast forward to late 70s, early 80s, and we, through doing a deal with FedEx, became very enamored with Fred Smith and what FedEx was doing to the supply chain. My father was a merchant marine as an undergraduate. He had been to all the ports on banana boats. So he understood the supply chain. Then he went to Yale Law School. He was very impressed with the way the Federal Reserve was promoting REITs and endorsing REITs and getting behind the ability of John and J.Q. Public to own commercial real estate. It shouldn't just be the source of dynastic wealth. Everybody on the grassroots level should be able to diversify away from stocks and bonds into real estate. So he embraced it. He was a REIT pioneer. And the two property types he realized made a lot of sense was manufactured housing communities, because it had moats around it, very difficult to build competing product, and single tenant net lease industrial properties to long-term leases to investment grade tenants. So that wasn't capital intensive. If you have a long-term net lease to a FedEx, a Coca-Cola, they're responsible and they have the capital to take care of the building and live up to their end of the bargain. If you have a net lease to a startup, you may very well have to use your balance sheet to do some of the things that they're obligated to take care of. But when you have strong tenants with long-term leases, we were able to manage at the end with 15 people, 125 properties and 26 million square feet, because we had strong tenants and they were the ones who were responsible for taxes, insurance, and the maintenance of the building. So, and then these big tenants, as time evolved, the buildings became smart. It wasn't just racks and forklifts. It became multi-million-dollar digital buildings that the tenant had to often put an investment in the infrastructure greater than our investment in the building itself. And that created a stickiness where leases got renewed and buildings got expanded. And so we always had the highest occupancy. And we always, because we had strong tenants, saw them as partners and worked with them, not in a zero-sum manner where we're haggling over what the rent per square feet should be in the new lease. We would come up with an escalation, but not a draconian one. And so the bean counters out there and the analysts would be, they're leaving money on the table, but they're not seeing the big picture. We were getting a lot of new great buildings from FedEx, new constructions, expansions, and just had our finger on the pulse of demographic shifts, supply chain shifts, et cetera. So it was really a win-win rather than play the zero-sum game. And by treating FedEx as a partner, it paid tremendous dividends and built a highly coveted portfolio that there was certainly no shortage of demand. You're right, we didn't foresee everybody shopping online, the advent of Amazon. But what we did foresee is that the death of FedEx was overrated. When fax machines came out, they said FedEx is doomed. Everybody's going to fax documents. But FedEx shipped fax machines. Then they said, oh, now scanning devices. You can actually, in a click of a mouse, take a several hundred-page document and disseminate it to thousands of people. Who needs FedEx? Well, FedEx was shipping scanning devices. And so then the internet came and we knew that they would benefit. And so, technology tends to be the catalyst for a lot of economic growth if you look way back. And so the digital revolution took the industrial property type and really turned it into maybe one of the best performers. Certainly it went from an also ran to one of the bells of the ball, and it will continue to, because now, ever since the Cold War, we had this tranquil global environment, and now there's geopolitical hostilities and tensions. So you're going to need to shorten the supply chain. You're going to need to realize where you're manufacturing, where you're storing goods. People are reassessing globalization. And so I think this hemisphere is going to benefit. It's the world at large, it's a step in the wrong direction, because Fred Smith is fond of saying a world of free trade, no tariffs, no stimulus, just free, unfettered, open markets is the greatest growth engine there is. And we had that for a long time. Now we don't. But American industrial, you can't find land. Placement costs are going through the roof with inflation. So I think the company ILPT that bought us is poised to do very well. And I'm still very bullish on industrial, notwithstanding the fact that Amazon said looking for subtenants because they overextended themselves. They took the COVID trajectory and extrapolated that out to infinity. And yes, that's going to hurt. It's going to create less demand, but more to fill that demand will be manufacturing coming to US shores instead of just-in-time inventory, just in case, overstocking. So I think there are more catalysts to be bullish on industrial than the fact that Amazon went and became vertically integrated too far and too fast.
So let me ask you this, that all makes total sense, but in addition to kind of the headwinds from the Amazon statement, everyone seems to have now figured out what you figured out 2 decades ago, which is this is a very good space to invest in. So there seems to be a lot of capital chasing the same properties, number one. Number two, we are dealing with an inflationary environment and interest rates are going up. So with all of that, if you were running the company today or starting a new company today, is this still the place you would focus on?
Well, no question, values were at record levels and then they went into overdrive real quick because of COVID. People, real estate investors who were looking across the property types saw that hotels would be challenged for the foreseeable future. Office, suddenly it was hard to collect rent and people are working remotely. And retail was already in the penalty box because of e-commerce and only more so when you weren't allowed out of your houses. So that took a lot of capital and had it zero in on industrial. And so cap rates suddenly deteriorated even further. But the thing about real estate is land is finite, the population is growing, it's inflation protected, the commodities to build heating product are going through the roof, so replacement costs are rising. So if you sold an industrial portfolio for 200 a foot, and the guy who bought it thinks they're going to 300 a foot, he's probably right. Over time, they will. And you know, analysts, one thing I learned at NYU was all real estate is unique. Every asset has a different story and different characteristics. And with us, a lot of our assets had land around the building, excess land, in which we could expand the parking, expand the building. And the ports today are so congested, they're knocking down old buildings to store shipping containers. And so the rent that the raw land is getting to store shipping containers is equal to and at times greater than the building rent. And these short pencil analysts were saying our rents are above market, you know, because they're slicing and dicing them at a metric called rent per square foot. Well, what's the rent per square foot on land, raw land holding shipping containers when it's greater than the rent per square foot in a building? So our buildings maybe had $9, $10 per square foot rent in $6, $7 markets. And so a lazy analyst is going to say it's above market. On renewal, the propensity for that rent to roll over is very great. The leverage is in the tenant's camp, not in the landlord's camp. But they're not looking at all the parking, all the productivity that's going through the building. FedEx went from 5 days a week shipping to 6 days a week, then 7 days a week, and then 24/7. So that's where they are now because of COVID and e-commerce, 24/7. And they need lots of van stalls. They're also, instead of doing just B2B distribution, they're doing last mile, B2C. So they need a lot of additional vehicles. And so you're comparing apples and oranges when you compare a FedEx rent with an old warehouse with a forklift and racks. And then FedEx is going to need to go green. They've made those ESG proclamations of being carbon neutral. So they're going to need charging stations. They're going to need solar panels. And you're going to, as a landlord, help finance that. And that's going to take the rents even higher. So it's apples and oranges comparing our portfolio rents with the general market. It's apples and oranges because it's real estate. And those are just general statements. And it's something that a lot of people get, but a lot of analysts don't. It boggles my mind that company that went for $21 a share, there were analysts, one analyst who will remain nameless, had a $13 target on us. You know, and these are single tenant, net lease industrials and long-term leases to investment grade tenants. It's not rocket science. The guys at NYU know that, you know, that's not even in the same solar system, 13 and 21. So I'm not saying everybody has to be within 100 basis points, but So then it's like, is he a bad analyst? No, he's not a deaf, dumb, and blind analyst. So then why? And that gets into M&A. I'll just
Yeah.
stop there.
So what about the REIT vehicle itself as a vehicle? You guys were one of the first REITs out there, and you've seen a tremendous evolution in the REIT vehicle, some complexities that come with it. What's your overall view of the vehicle, and where do you think the REIT vehicle and the REIT market is heading as compared to private real estate, for example?
Yeah. So looking back, it performed better than people could have ever dreamed. It grew from under $1 billion in capitalization, and then the modern era took it from 10 billion to over 100 billion. It's several trillion dollars now. It's over long periods of time. It's outperformed stocks and bonds. It's liquid real estate, so it's a better mousetrap. When you own private real estate, there's no exits. You're stuck with it, and if you want to move to something else, you might not like the pricing of a REIT, but it's liquid. On Wall Street, it's trading, and you choose to hold it or not. The dividend story is remarkable and something that it's just not right when analysts don't look at total return. If you look at ISS and Glass Lewis, sometimes the way they rate REITs versus the broad market is stock price only, which is so disingenuous because over the long period of time, one of the big reasons Monmouth outperformed is we maintained our dividend in the global financial crisis when most REITs could not. Their dividends went to zero. And then at times they paid a stock dividend. It was like quantitative easing on the REIT level. Instead of paying cash, they were issuing out dilutive shares. Our dividend marched on, didn't miss a beat. And then, the proxy advisors will put out a chart, Exhibit A, page 1, S&P 500 outperforming us. And then you read the footnote, price only, and a big part of REIT dividends used to be 2/3 of total return. And REITs had a big capital appreciation recently, but it's probably half now. Half of total return is dividends. So you're tying one arm behind our back if you're not counting the dividends. So I do think it's proven to be the better mousetrap, publicly traded REITs. It's worked out and created great diversity for mom and pop investors to own real estate. The problem now, looking into the future, is the average holding period on the New York Stock Exchange decades ago, it was over 10 years long, people held stocks. And recently it's fallen to 7 months is the average holding period. So there's a lot of day traders out there. There's a lot of people just moving money around. And 7 months, you're getting 2 dividends maybe. So real estate's a long-term asset. It's something that's not volatile. It makes money, as Mill Cooper said, in your sleep. As the population's growing, inflation. So it's something that you just put away, and it's a great diversification tool. And I think the way the market churns now, it's a bit of a mismatch for public companies of REITs, the directors and officers, to have to meet with investors who want to know why you missed a quarter by a couple pennies. There could be very good reasons why you missed, because you're investing for the future, but nobody's looking at the future. They're looking, the future's not even a year away for them. It's a couple quarters. And so that's a mismatch, and that's a problem with being public now when you have a long-term asset like real estate.
Short-termism is yeah.
For instance, our deal, look at stock for stock deal that there was a cash offer that on the spot was 100 basis points more than the stock on the spot. And so they're calling that superior, but we're saying, we know with FedEx and expansions and all the seeds we planted, that stock is going to be worth a lot more than 100 basis points more than it is today. And shareholders have the option of taking cash. There are a lot of reasons why, in analyzing our deal, there were a lot of long-term investors that found themselves at odds with the short-term pressures of the index funds and the proxy advisors. And the short-termism, here's a good example of the short-termism. You know, you mentioned one of the best performing REITs over a long time. We're one of the oldest REITs. So they look at average tenure of directors. And the median average is a meaningless metric, because the median includes REITs that just went public, and it includes REITs like ours, which are the oldest REITs, and the chairman, who's still on the board, has been on for 55 years. So that skews the numbers. So they're dinging us for success, and longevity, durability, and resilience. And that's entrenchment, you know, and
Right.
Those used to be virtues.
So let's talk about the sale. A unique, very interesting M&A transaction that ended up creating tremendous value, and in the end went well. Any key lessons you take away about REIT M&A? I know there were a lot of twists and turns that led to this, so be curious your overall hindsight reaction.
Yeah, no, it's a great question, because there's so many lessons that one day I do want to write a book. In the meantime, there is a great book. It's called Barbarians at the Gate. It's written in the 80s, but the lessons still apply. And the book talks about, you know, and our situation speaks to. There's a gravitational pull on Wall Street towards transactions. I mean, for the students, if you do your job well and build a great portfolio and grow an enterprise of value, that's the name of the game. Build something of enduring value, but be aware as you do so, if you succeed, there's a target on your back getting bigger and bigger and bigger. And the big guys out there, you know, appreciate all the work you're doing, and they're happy to acquire you. And then no matter how well you envision the future, and Robin's talking about, you know, doing well as the economy shifted from brick and mortar to a digital economy, there's a lot of things in the future with the supply chain. We saw the Panama Canal expansion driving shipping containers from the West Coast to the Gulf of Mexico, up the Eastern Seaboard. We invested accordingly, and that's playing out in real time. The Port of Savannah just had the busiest month ever in May, and that's just going to continue. So, and we had assets invested accordingly that were precluded from participating in unless we invest in LPT that now owns the portfolio we built, and that's what we're doing. But it is a bit of an environment where transactions happen when it's out of your control, and there's certain, as the book Barbarians at the Gate, and my book should probably be Barbarians in the Gate, or maybe
Barbarians in the House.
where I was thinking, Scott mentioned a book to me once, Good to Great. I didn't get through the whole book, but I read enough of it. Maybe since that's already taken, how about Great to Gone? But anyhow, I don't know what to call it. Book, and I'm into music these days, so who knows if it'll ever get written. But there's a Machiavellian aspect out there today that would make Machiavelli himself spin. He'd be astonished with the ruthlessness that goes on. And I don't want to, you know, rain on all the students' parade, but keep your eyes wide open. And if you ever get in a situation where you're contemplating strategic alternatives, you're forced to contemplate strategic alternatives, you know, one of the best things we did was hire Robin and his team at Wachtell Lipton. I can tell you, we used a lot of firms. They are head and shoulders the best of the best, without question. And one of the reasons we had a great ending is because they rode to the rescue. And so I'll never forget that.
Thank you for that, Mike. The marketing department will send you a check later.
No need. You're very happy.
So I would love to chat about the other company you're very involved in, UMH. You're a director there, and it's one of the other sectors that your family focused on over the years. Again, very much ahead of the curve, manufactured housing. Tell us a little about that business and why you guys focused on that. Everybody now understands, I think, a little better what all of the moats around it and so on. But you guys were way ahead of the curve on that. So what opened your eyes?
That's a great question, because that's how we invest. We invest conceptually. There's always a concept, whether it's the Panama Canal expansion with industrial, or the population. Most of the U.S. lives east of the Mississippi, yet all the REITs are in industrial are focusing on California, so we own nothing in California. You know, where is the puck going? So the concept with manufactured housing is there's a fundamental need for housing. I mean, everybody's born short a roof over their head, and they're going to need a roof over their head. And a lot of people, blue collar workforce housing, is priced out of the market. And the product, manufactured homes, are made in a climate controlled environment. The materials are purchased in bulk, and there's tremendous savings when you build in that sort of efficient manner. And so to provide affordable housing and build site built or watch the apartment rents skyrocket, it becomes an increasing need. In fact, today, with median home prices jumping from over $250,000 to over $350,000 rapidly, and apartment rents at record levels, there's never been a bigger shortage for manufactured house, for affordable housing. So manufactured housing suffered for quite a while with GSEs subsidizing conventional homes, and it was a real headwind. So you had Fannie and Freddie helping the stick-built guys, and the manufactured home financing was a chattel loan, and it was at usurious rates. So, and yet it did well despite all that, but it priced a lot of people out. One thing UMH did that was really smart, they started renting the homes because the financing costs were too high, and they were able to fill vacant sites through rentals, and the tenants tend to stay a long time and take care of the property, so it wasn't a lot of turnover like people feared. Now, it started with the HUD Secretary, Dr. Ben Carson, and continued with the new HUD Secretary under Biden. I can't think of her name right now, but they've been really helping the MH sector. They provide Fannie and Freddie financing at a much lower rate, and they see it as the solution, big part of the solution to the shortage of affordable housing. So you went from this legislative headwind for decades and decades to most recently a tailwind, and that's really created a huge inertia and momentum for the sector. Now, there's only 3 players in the sector, in the publicly traded realm, and that's Sam Zell's Equity Lifestyle Communities, Gary Schiffman's Sun Communities, and then little UMH, which is much smaller than those large REITs. But it's different than them because those guys are largely owning retirement communities, 55 years and older. They own RV parks and they own marinas. And UMH is a pure play, all age, blue collar, workforce housing, manufactured housing REIT. And they have really resonated with Washington. And they just modeled a home on the mall in DC, and with a great reception, written up, great publicity. And on top of all that, all those tailwinds, they own thousands of acres in the Marcellus and Utica Shale region. And so one day, hopefully in the not too distant future, the mineral rights for vacant land that UMH owns, adjacent and under its communities, will be very valuable. So UMH is a great long-term investment to compound your earnings through dividend reinvestment. You've got to match it with the right investors and not the short-term people who don't fit, as we said earlier, in the whole REIT space to begin with. It's one of the oldest REITs, and hopefully it will continue to function in the public space, and raised its dividend recently. Occupancy is climbing and rents are rising. Now, the short-term guys want UMH to raise rents double digits, and you pound the table. Why don't you raise rents 10%, 11%, 12%? UMH raises rents 4% because, again, it's that philosophy of looking at your tenants as partners. You want a nice community. You don't want churn. You don't want to throw people out who now have to deal with $6 a gallon gas. You want them to know that this is a great stable community and not play zero sum. So again, in the long run, UMH will be a bigger, stronger, more successful company by raising rents 4% than it will by raising 10%. But some people can't do that math.
One more question, and then I've been hogging the mic. I'm going to let Scott ask some questions. But on the UMH, the house that was put on the mall, you guys don't build those houses, right? You're not in that business. You just own the land that then you put somebody else puts the houses on, or how does it work?
No, that's correct. The manufacturers have manufacturing plants around the country, and they need more plants. The biggest manufacturer is Warren Buffett's Clayton Homes. Bought a company that the Clayton family started out of Knoxville, Tennessee, put it in the Berkshire Constellation, and grew it to the largest home builder in the world. So there's others. Cavco is a good manufacturer, Skyline, and UMH buys from those manufacturers. They're great at what they do, and UMH has a long relationship with them. There's a backlog now because people, the supply chain has all sorts of gridlock, and so homes aren't getting delivered as fast as we could sell them and rent them, but that should work itself.
So how do you grow the UMH business? You're not building those homes for other people's land. You need land to put it on, yet there are zoning restrictions that prevent a lot of that. So how do you grow the business?
It's a blessing and a curse. You know, the blessing is there's moats around your assets, so they're very valuable, and people who want to get into the space, the first thing they look at is who owns a portfolio of this, because it's so hard to recreate. It's so hard to get approvals. UMH has done a very good job of taking communities that mom and pops owned, that they didn't have the financial wherewithal to maintain them and upgrade them. So UMH bought them, fixed them up, filled them, and it worked a lot more. I was just at a UMH board meeting, and there were communities that I knew because I helped underwrite, and occupancy's way up, the revenue's way up, and the value per site is over $100,000 more than we paid for it. So when you see a mom and pop that needs capital, you know, often that's a good way to get in and buy from them. UMH has acreage that it's trying to develop, but they've been over 10 years in Coxsackie in court trying to get approvals to build a new greenfield development. That's how over 10 years. So it's next to impossible to do. You have to be very patient.
Mostly you're buying others and then putting capital in and improving them.
That's right. And whenever land is available adjacent, just like we did at Monmouth, you make sure you buy the vacant land, and often it's a lot easier to expand an existing community.
Got it. Got it. Scott, I've been hogging the mic. Your turn.
No, it's great. I appreciate it. Mike, you've been around the REIT sector for quite a while. You've been through a few real estate cycles now. You have a varied and diversified background. And earlier we were talking about some secular trends in the economy vis-a-vis logistics and e-commerce. And obviously we're coming out of COVID now. From your vantage point, where are we in the property and economic cycle? Do you see more economic headwinds? Do you see more REIT M&A? Do you see more REIT IPOs? Maybe we'll start with kind of the property focus first.
Well, it's hard to answer starting with the property. I would start with Federal Reserve. You know, we've been in like a real secular bull market for the bonds for over 40 years. And then with every economic downturn, they felt compelled to get into financial engineering and not let the economy tank. It's almost like the Federal Reserve became somewhat political. And so you had QE 1, 2, 3, now QE infinity, to the point where the Federal Reserve had a $9 trillion balance sheet. And so that financial repression didn't let true price discovery happen. And you had cryptocurrencies worth $3 trillion. You had virtual real estate and people buying virtual art to hang on virtual walls with virtual currencies. You know, so in other words, it got bubble-licious. And that's what's going to happen when you could just take a fiat currency and print it out of thin air. And now the Fed is saying they're committed to unwinding their balance sheet. and they've barely gotten started, and the market is tanking in real time. So I don't know if they'll ever be able to get out of this quagmire. And one thing for sure is the allure of crypto. Okay, the only utility it serves is for the pirates and the money launderers, but the only allure for an honest person is that the Federal Reserve is going to make a $20 bill worth a nickel. And that's why real estate is such a great inflation hedge. You want to own land because they're not making any more of it. And if it's well located, like here in America for the most case, you're ahead of the game by owning real estate. So I'm very bullish on real estate in an inflationary environment. But globally, because it wasn't just our Federal Reserve, it was the Bank of Japan, it was the ECB, all pumping money out of thin air, that, you know, this party's going to end and there's going to be big hangovers and a lot of fallout. And you know, to do that and then overlay ESG and say, you know, no drilling and $10 a gallon gas, you know, I think the economy is probably in a recession now, and will the Federal Reserve blink and say we're not unwinding our balance sheet and perhaps start delivering more money via helicopters? Who knows? But once you get into this vicious cycle, it's hard to get out of it. And so, you know, I think when we were getting back to the Monmouth transaction, Sam Zell wrote a letter saying now is not the time to sell the industrial portfolio for cash. You know, and yeah, he got that. You know, he got that, but he got outbid too, because it's the book he wrote. Money talks, bullshit walks. So,
look, when I first met your father, Gene Landy, he literally broke out a napkin and demonstrated the business plan to me as an inflation hedge, mapped out inflation rates and interest rates and amortization on mortgages and how you come out ahead. Are we still in that type of environment? Are we still very forward looking on property values because of inflationary pressures?
Well, the napkin analogy, napkin story, I think, anecdote, speaks to keeping it simple. You know, if something can't, and Peter Lynch used to say the same thing, if you can't explain it in simple terms, then it's too complicated and it might not be a good investment. And real estate, for so many reasons, has proven itself, demographic shifts and inflation and everything. Now, as far as rising rates and, with 8, 9, 10% inflation, real rates are still very much negative. So, and financing for good industrial is abundant. So you know, it's still a very favorable environment to go out and buy real estate. There'll be another factor when real rates are positive, but we're a long way from positive real rates. Monmouth had $550 million of perpetual preferred. And we're long-term investors. The idea there was, because of all of the financial repression, because of all the quantitative easing, negative rates, who would have thought negative rates would ever be a reality? I'm not talking negative real rates, I'm talking negative nominal rates on a global basis. Let's issue permanent capital. So, you know, at one point our cost of preferred was very high. It came down to 6, and we issued a ton of it. We had over $500 million in preferred. And the short-term guys started saying, we're bad capital allocators. That's expensive capital. Well, guess what? It never matures. It never, you know, if we want to redeem it, when it becomes redeemable, we can. And it wasn't redeemable, so it was a specious argument. There's nothing we could do with it. And now you fast forward to today, that's an asset. 6% capital permanently. And I know Public Storage, they have very little debt, and so they slept better at night during the financial crisis than anybody, because, you know, you had a real liquidity crunch. The capital was not available, but their maturities went out to eternity. So there's something to be said if you're playing the long game. But now in a world where the average holding period's, you know, calculating days and not years, it's hard to explain to the investment public why you're using expensive capital like preferred. Of course, floating rate debt's shorter, but the interest rates is cheaper, but the interest rate's moving in real time. So you got to find the right investors that get that and believe in, you know, whatever he wrote on the napkin. And I didn't see it, but I'm sure I could tell you it works over time. There's a spread between your cost of capital and where the NOI is and where it's going. But you got to be in the game long enough to enjoy that. I did all my money was in Monmouth. I took the dividends. I reinvested in Monmouth every quarter, and it's proven.
So where are you investing these days?
Well, I have a weird thesis on gold because I think the crypto market took a lot of air out of the gold, and a lot of market share that would have been in gold went to all these, whatever the Bitcoins are called. There's a lot of them and they all own each other. So once one tanks, they're all just, it's just going to be a house of cards. And then people will realize gold has a real utility. So, and cash I worry about, you know, because cash is expensive and it's getting more expensive. But I do think the market hasn't bottomed, you know, and guys who are brokers and analysts and participants in the market like to tell you you can't time markets. You know, well, timing is everything. You know, they just want you in the market. They want you in the market, transacting, buying options, selling, puts, calls, all that, because they get fees every step of the way. But you know, Buffett's fond of saying, picture a guy at bat and he gets a lot more than 3 swings. He can sit there forever and swing when he wants. So in other words, you can time things. You have to find timing's everything. The way the retail REITs have been priced, it's as though they're all going the way of the dinosaur. But now Amazon's proven that they're not going to have the world domination. There's no such thing as free shipping and free returns. Okay, somebody's paying the shipping, somebody's paying for the returns. You know, Jeff Bezos' great investment before there was, or invention, before there was negative interest rates, was negative profit margins. So he had these little robots in milliseconds could see what the lowest price for any good was, and he'd be lower instantaneously. He didn't care how negative his profit margin was. He just wanted market share, and he got it. But then he became vertically integrated and said, we're going to be the shipper, and we're going to do the returns, and all that's very expensive. As brilliant as he was, he had this cloud computing company that helped them get profitability much faster than they otherwise would have. That's a long way of saying, I think the doom and gloom in brick and mortar retail is overdone. And a lot of these companies that went bankrupt that don't exist anymore in that sector would have made it, but they got hit with the 1-2 punch. First, the e-commerce took market share away, and then COVID wouldn't let anybody in the stores. And so they were doomed. They couldn't have a more perfect storm. But a quality company like Kimco has grocery stores and retail outlets that I don't think will ever become obsolete. And they're priced, you know, at real big discounts. So I'm looking at that. And something that will probably take a lot more patience is CBD office. Boston Properties has some great assets. They're trading at real big discounts, levels they haven't been at in ages. And I've read some great analysis that remote working is here to stay. The technology enables people to be efficient 24/7 from wherever they want. But there's a certain magic that happens when everybody's under one roof, collaborating. Not for every industry, but for many businesses. You really want to have that ability to consult with each other and see each other. And it creates a better team for certain projects. And so I don't think, you know, if you believe there's a future for Chicago, Boston, New York, Dallas, LA, et cetera, then Boston Properties and other CBD office REITs are probably good investments. Rents will probably roll lower because certainly a tenant's market, it's not a landlord's market, but I'm one of those minority people who take a long-term view.
Yeah, Robin and I have been struggling with we'll call it the occupancy differential between the sidewalks and each consecutive floor up in office towers. I think there's definitely some differentiation between the A and B class assets for sure, but yeah, cities are under some pressure. Hey, Mike, we're definitely at a crossroads in the economy, global economy, maybe also the real estate markets. You went through the program before the credit crisis. You've seen a few cycles now. You've shepherded a public company for decades. What type of advice would you give our Schack students today who are winding down their studies and starting to think about a career? What type of advice or direction would you give them?
No, it's an important question. This is a lot of lessons I learned the hard way. And I think my best advice would be it's so important who your partners are. You have to be very careful who you choose to partner with. Generally speaking, and this conversation kind of touched on a lot of it, there could be two camps. You could divide the world into two camps, business world. You have the real sharp pencil bean counter guys who think value is created in a zero-sum manner, that you need to extract the highest rent, you need to cut expenses, you need to take something of value from someone else to benefit. And then the other side is more creative. The other side, called the value creators, people like Milt Cooper, Sam Zell, Gene Landy, who can create value just because they see out over the horizon so well what the world's going to look like. And then they invest accordingly. And then when things play out the way they thought, presto, there's tremendous value. And it could be as simple as nurturing a relationship with a tenant over time. Next thing you know, their business is booming and all these great real estate deals are falling on your desk. So it hurts when, because you won't always succeed. And sometimes, someone you thought was a good partner won't be, and that's painful, but it's so important. A lot of this ESG is the Trojan horse that's used to create transactions. And I believe in shareholder primacy, not stakeholder capitalism, but the old school method of create long-term value for the shareholder. I think that ultimately does more for ESG than stakeholder capitalism, because if you're trying to build a Super Bowl winning football team, you want the best people in each position. You want a well-oiled machine. If suddenly the stadium is sold, half of the stadium has index funds in it telling you we need a diverse backfield and we need X people and the line looking like this, looking like that, and winning isn't everything. We got to do it. Well, that does less for generating wealth than going out and trying to put points on the board. So we're taking our eye, we're trying to do too much, and we're taking our eye off of the mission. And next thing you know, nobody's going to the stadium because they're all investing elsewhere. And all the restaurants around the stadium, all the spouses and kids, the whole community, it's linked, and it all struggles. So my point there is find the right partners. Try to have a prosperous business. Treat everybody like a partner, your tenants, your investors, your advisors, and it will create wealth. And it's easier said than done, but at the end of the day, ESG is trying to make the world better than you found it. So to the students, don't sacrifice your soul. Easier said than done. They don't teach ethics enough at school, in my opinion, especially at law schools. And so you got a lot of Machiavellis out there running around. And make sure you have integrity and ethics, and you play the long game. Try to win Super Bowls because not everybody gets the Lombardi.
Nice. That's great advice. We're actually adding more ethics and related stuff into the curriculum later this year. So good insight. I want to be cognizant of your time. Robin, you want to wind it down and take us out?
Yeah, no, I love the free-ranging nature of this conversation. And I think one of the things that came through to me, which I think is worth the students paying attention to, is you don't seem constrained by conventional wisdom or the latest fashion. You guys, I love the napkin story. If it's too complicated to get on a napkin, If it doesn't make sense, it probably doesn't make sense as an investment thesis or anything else. So invaluable advice. Can't thank you enough, Mike. And it was great to see you. Good luck with all the music.
Thank you, guys. My pleasure. Thank you.